Welcome to Geojit Spotlight. The sudden upward movement in July was the result of several factors. Geojit Chief Investment Strategist Dr.V.K. Vijayakumar joins us to share his views. Welcome, Dr. V.K. Dr. V.K., what are the factors driving July rally?
Well, the rally in July has been a pleasant surprise. Nifty is up by more than 7% this month. And if we take from the lows of June, the market is up by, Nifty is up by more than 10%. And this rally has come at a time when globally the macro developments have turned a little bit negative. There is a growth slowdown in the US. There is a sharp growth slowdown in the Eurozone. China also is slowing down sharply. So that's why I said it is a pleasant surprise, the market rallying when the economic fundamentals globally are turning a little bit negative. But that is how the markets behave. Sharp rallies and sharp corrections both can happen at the totally unexpected times. Now, there are mainly three factors driving this rally. Number one, even though the US is technically in recession with the 2 consecutive quarters of negative GDP growth, the fact is the US economy continues to be strong. Normally, when an economy goes into recession, the unemployment will shoot. The unemployment rate will be around 5 to 6%, even more than 6%. But unemployment in US now is at a 50-year low of 3.6%. The US job vacancies are at historical highs. So market feels that the economy will not go into a recession. And therefore, in the coming months, the Fed will go a little bit slow on further tightening. One more large tightening may be announced in September. But after that, the Fed is likely to go slow on monetary tightening. This is number one positive for the markets globally. Secondly, energy prices have come down sharply. Not just energy prices, all commodity prices. Crude oil is down by more than 20-25% from the peak levels. Then metal prices have corrected between 20 to 35%. Edible oil prices, which is very important from the inflation perspective in India. Edible oil prices are at a 1-year low. So the market expectation is that inflation has already peaked out and therefore inflation will start coming down. In India, inflation will continue to remain elevated till December, but then it will start coming down in 2023 onwards. Therefore, the RBI will not have to tighten monetary policy aggressively. This is the second factor. The third factor, and this is very important from the Indian market perspective, and this factor is foreign portfolio investors have substantially slowed down their selling. They have been selling relentlessly in the market from 2021 October onwards. Last month, they sold more than 50,000 crores. The month before that, more than 33,000 crores. But in this month, July, the selling has come down substantially to around 6,000 crores. And in some 8 days of this month, they have turned buyers also. So the fear of relentless FPI selling is not there in the market now. These are the three factors which have acted cumulatively to contribute to this very pleasant, smart rally in the market.
Is there any lesson that investors should learn from surprising sharp rallies like this?
That's a very important question. There are many lessons which investors should learn. And the most important lesson is that it is impossible to time the market. Trying to time the market is a futile exercise because market rallies and market corrections will happen at totally unexpected times. So investors who try to time the market will always lose out. So don't try to time the market. Invest systematically. The market, if an investor feels the market is overheated, overvalued, then he or she need not invest more. He can simply keep quiet. But then the best strategy in the market always is to remain invested. Suppose a person sold out in June, mid-June, at the low levels of June at Nifty at 15,183, then that investor would have lost this 10%, more than 10% in the rally. So the important lesson, I repeat, is don't try to time the market, always remain invested in the market.
What's your take on the Q1 results released so far?
Well, all Q1 results have not come, but most big results have come. I will give you my view based on the results that have come already. The most important takeaway from the Q1 results is the spectacular performance of the financials. Financials, particularly the leading banks and also NBFCs like the fintech companies, they have done exceedingly well. And in the leading banks, ICICI has come out with the best results. For the banks generally, leading banks, their asset quality has improved substantially, provisioning is down, and more importantly, credit growth is steadily picking up. So these are very favorable indications for the banking segment. And from the NBFC segment, from the results declared so far, the results of the Bajaj twins, Bajaj Finance and Bajaj Finserv stand out with improving prospects, improving revenue growth, and all the indications are that in the coming quarters also this trend is likely to sustain. This improving performance of the financial sector and the improved potential and the improving prospects for the segment, we have been repeatedly saying, even in the video that we released more than a month back, even 2 months back, this particular point was emphasized, that financials present a good investment opportunity because their fundamentals are improving, but prices are coming down because of foreign portfolio investors selling. Now this strategy has actually played out for those who heeded that advice and made investment based on that. Then coming to the IT results, the important takeaway from the IT results is that there is margin pressure in the industry. Attrition has been rising and it continues to rise. Because of this rising attrition, employee costs are rising, and this is putting margin pressure on the industry. So the prospects of the industry has been slightly hit because of that, but the order growth for the industry is good, order visibility is good, deal wins are good, but the market is more concerned about the likely fallout of a US slowdown or a likely US recession on the technology spending of US companies and thereby on the possible decline in the order book. This is a market concern. That is why these companies' stock prices have corrected. Another corollary to this view is that the mid-cap IT has done better than large-cap IT. All the mid-cap, most of the big names in the big cap IT, the mid-cap IT, like L&T Infotech, L&T Technologies, Coforge, Mindtree, Persistent Systems, all these have come out with good results and without much of a hit on the margins. But the markets have already discounted the valuation of IT mid caps are actually higher than the valuations of IT large caps. The prospects for the industry as a whole continue to be bright. So there is a possibility of a bounce back in stock prices. It is already happening now as we speak. Then regarding other important takeaways from Q1 results, in the capital goods segment, the major result that has come is that of L&T. L&T is a barometer for the capital goods segment, and their order book is good, results are good. And if the order book of a company like L&T is growing, that means investment in the economy also is picking up. So that is good news for economic growth also. Coming to FMCG, based on the results so far, we can say that the FMCG companies, most of them have succeeded in passing on the increased input cost to consumers. That is a positive. And in the coming quarter, because the input prices have gone down, their prospects will again start looking up. Then other results, well, results of Cement companies are yet to come. So these are the broad takeaways from the Q1 results so far.
Thank you, Dr. V.K.